And so this is sort of the key issue that I think we have to face as a community, and that nobody really talks about. I will talk about one way it was addressed, which wasn't a great solution, and my opinion was actually invalid, is that you sell membership at a market price, so that if you're leaving a startup, you don't sell membership to the next guy at the value of your internal capital account. You sell it at a bit of a premium, because you started this, and therefore you should have a right to some of the future profits, and that's the reasoning. And the plywood cooperatives in the Pacific Northwest basically did this. People would go around starting them and then selling the membership at a market-based price. And what was that market-based price? Well, it was the expected future profits of the business that the member could expect to appropriate by being a member. And it's sort of a ridiculous idea that a new member of a co-op should be expected to pay upfront for all the future profits that they're going to earn through their labor. I don't know how else to explain it in a way that makes it sound less reasonable, but that was basically what was going on. And the idea is that you can't really sell these future profit rights and in any way be consistent with basic worker cooperative principles, mainly member profit appropriation. But there is this big debate, and I am advocating a minority opinion, because everybody who goes to business school or learns finance learns that there is goodwill, and it is the discounted, cash flow, or discount, the discounted value of future profits, and that's the present value of any investment, except that it doesn't apply to worker co-ops where members are the owners. But these ideas are still very prevalent, and it's actually sort of an ongoing debate. It's not settled either way, even though there's very clear theoretical arguments that it's not actually a current asset right. Goodwill is not a current asset right. You actually have to earn those profits. And even the, sort of as an aside, even the accounting is a little bit bipolar on this topic. For example, if you're starting a business, you can't say, oh, I have this goodwill, I'm going to expect to make profits in the future, and record that as an asset on your balance sheet. That's clearly bogus. You should actually go and earn those things. And you can't say these future profits I'm going to earn are a current asset. However, if you purchase another business, you of course don't pay the net asset value, you pay the market value, which includes the goodwill, and values it based on its future expected profits. Then you have a component on your balance sheet that is goodwill. And so you can actually get goodwill on your balance sheet. And that's sort of a very standard thing to do in mergers and acquisitions. And it's not a real asset. It's an expected future profit right.
Determined by how?
Determined by whatever the market thinks the future profits will be and the risk-free rate of return will be. So you basically take all the future profits at whatever time they're expected, you discount them by the risk-free interest rate, and you get a present value of those, and that's what you value it at.
But is this done by like a third-party
investment bank?
Investment
banks do.
Well, yeah, investment bankers, or the largest place it's done is the stock market.
Okay.
All the valuations of the stock market are not the net asset value. It is based on the future expected profits. So it's extremely prevalent, this idea of goodwill, in our culture and our economy. It's not some trivial concept to kind of beat down.
I understand you have a reservation about that, but the system you're talking about does require someone to do asset valuation on a periodic basis, right?
Which the asset-backed security.
Mm-hmm.
Yeah, and that's actually an issue of how you do that, because if in the absence of transactions, the price is in fact undetermined. So it would either have to be appraised, or there have to be an active market for it. And there are some technical ways to do that, which is probably too detailed for this talk, but that is one of the issues that we thought about.
Do you have a sense of what the cost of that is? Because I know for ESOPs, for instance, the appraisal costs themselves make it impractical for smaller businesses.
Right. It would depend on what kind of assets they were and how readily available the information was. So I don't know is the answer. But there's also funny things like for example, I mean, the market pricing is, in this way, is sort of like consensus, social consensus, which could be anything. For example, the flash crash in the stock market, if we were sort of market purists, those were the correct prices when prices dropped to a penny a share or zero or worthless because there were no buyers. Those are the correct pricing, those are the correct prices under a market system where market forces are at work, and that was a perfect example of market forces working. I mean, there's obvious manipulation and other stuff, but it wasn't strictly illegal what was going on. And so sometimes asset prices will drop to zero, and sometimes they'll skyrocket. And it's a question of whether, in practice, members of a co-op can bear those fluctuations. And I think in certain large businesses, it would be very hard. So, yes?
Is it fair to say that in starting a traditional business versus starting a cooperative, you could possibly find your way through whatever means to probably make more money through the traditional business route?
You can always find a way to make more money through the traditional business route because you own it and you have the rights to all future profits.
Right, so it sounds like that the person who may start a cooperative doesn't necessarily have that motivation. So while this is a component that might be important, the initiative to start a cooperative is so much more complex than financial incentives, that if someone's aligned with financial incentives very strongly, then they maybe should can the whole situation.
If their primary motivation is the financial return, they won't start with a co-op.
Right.
I would argue that what we're trying to do here is not necessarily equalize those financial incentives, and we shouldn't. The argument for worker co-ops is not that. By analogy, going back a few hundred years, could argue should worker co-ops out-compete slave shops, where you can own humans, and which is much more profitable, and the return is much higher. Well, the argument is that you should abolish slavery, not out-compete with financial incentives in worker co-ops. In the same way today, the argument should be about the abolition of human rentals, which violate the workers' right to profit appropriation and deny them responsibility for their actions in appropriating that profit or loss, as opposed to try to out-compete on the financial incentive. In the financial incentive game, which we can't do, and we don't actually want to do, but we do want to make sure it's actually fair to the founding members as it's fair to the later members. So, yes, you're correct in that the financial incentives aren't the same, and if you want to make money, go start a conventional business at the cost of violating the rights of the workers. So,
and if I can just add, I think it's kind of coming up in more recent conversation as somewhat of a contentious issue when it comes to outside investors, and how welcome are worker co-ops, or should they be, to outside investors. As Mike mentioned, some of it can be very capital intensive, especially manufacturing, and the traditional co-op model and principles, which has a clear limit on return on investment.
So hopefully this, well, anyway, I would argue that there are startup issues which I haven't yet addressed. The one way we don't want to do it is to sell market-based membership, because you're depriving the future members of their rights to the profits. So what I'm proposing is as a net loss model. So the issue is that when the founding members start a co-op, they put in a capital investment, and this investment is drawn down to cover the expenses of the co-op. What matters isn't how much that investment declines per se, but their net loss, which is that decline in investment offset by their wages. So the members of a money-losing co-op don't have any inherent right to compensation for their labor. The only right or obligation that they have is to bear that loss. And they can bear that loss without wages, or they can bear that loss with current income, getting wages or a salary, and increase that loss. But in the startup period, if you're paying yourself high wages, it's effectively taking money from one pocket and putting it in the other, because you're just drawing down your initial investment faster. And to the extent that you have to borrow money to finance that initial investment, it's actually detrimental to pay yourselves high wages, or wages generally. Minimum wage laws and whatnot withstanding. So the net loss is sort of the actual financial loss to the founding members, and I would argue that there should be compensation based on some factor times that net loss. And this gets into the issue of, you know, profit appropriation. I would argue that you actually have to remain a member while the co-op becomes profitable to get that compensation. Because if you're no longer a member, you should have no right to those profits. And that there shouldn't necessarily be any compensation for, you know, if you start a business and spend a lot of money, you don't know in the future whether or not it's going to be profitable or not. All you know is that you've contributed to a money-losing operation, and if you leave, then your share of that loss is yours. If you stay with the business, I don't think there's anything wrong with shifting a higher proportion of the future profits to the existing members in some skewed fashion. And of course there are wage differentials and salary differentials already, and maybe seniority and other stuff. But what hasn't really been addressed is the investment aspect that the founding members are making. So the founding members make this investment, and in all the models so far, they pretend that that investment doesn't decline in value, and that it sort of maintains its same value. And so you just sort of call it even at the end and say, well, no returns to capital, and therefore you ignore that this loss is taking place. And I would argue that that's in fact a mistake. We should really be acknowledging this loss and compensating for it, and to realize that this loss is actually unique for worker cooperatives and doesn't have to be faced by any other, you know, any conventional business or any entrepreneurs generally. But that even if, you know, sort of this loss isn't articulated all the time, that people sort of know what's going on and are sort of disincentivized from starting a worker co-op that might, you know, sort of be on the border of, you know, maybe let's choose a different model or something. And that this is really one of the things that we need to sort of address or kind of come to terms with or think about, and whether it's actually, you know, in line with our principles or not. So I'll sort of open it up to questions there and wrap. No one has issues about, you know, it's a return to capital, or
Essentially it is. Essentially you are, you know, you said that that's against the founding principles to give future profits away to current members, but you're just saying that we should do it just a little bit.
I'm saying we should skew the distribution of future profits so that they're more in favor of the members who bore these losses on their investments.
I think you're saying we should skew the distribution of present profits,
Yes.
or, you know, like at whatever moment in the future
Yeah.
it becomes the present. The question I had was, so if I, like the way the kind of like, so this is about just the startup segment because I can't speak to any other area of business. It's all I have experience with. But in the startup community, what typically happens is that you have a very small number of startups that return, you know, 10,000% or something, and then most of them fail, and then you have a smattering of ones that return, you know, double or triple or 5x or something.
Yep.
And the ones that return 10,000% are the ones that pay for all the losses and make it a profitable endeavor at all to fund startups and to be a part of that process. And I guess what I worry about in this case is, so given that if we were to map this onto a schema that will continue to exist as a functioning element of society where people are trying to start businesses with new ideas that are risky, the preferential allocation will be, you know, 10,000x the net loss. And so what that'll do is it'll suddenly create a graveyard for all the startups that would have been smaller hits, and because they'll never get out of that 10,000x hole, you're not going to turn, you know, a company like Mint.com into a Google. It's still a good thing to have, but it's, you know, this structure would create a problem with that.
Yeah, well, I mean, part of it is the contrast with the, you know, traditional entrepreneurial, you know, landscape where there's a lot of sort of kind of half-baked ideas that are out there, and you can sort of try them just because if you hit a home run, it kind of covers losses for a long time if you're an investor. In the worker co-op, you know, when you're determining this loss factor, it's an issue, one, of getting, you know, getting a fair value, and probably market determines it, but it's a issue of compensating the founding members correctly, and also being able to recruit later members, because if it's really that high, then it'll be hard to attract members.
I guess maybe the
at a later
members,
point in time.
or I would say maybe the members, you can start the cap at 10,000, and then as you get more information about what kind of business it is that you're actually building and what kind of market opportunity there is, because maybe it's much smaller, much bigger than you thought, you can, as the members, adjust where that multiple actually will be, dynamically.
Yeah,
And
so there's many ways to do it.
So if you do it dynamically, then that solves the problem, and you can downgrade it so that it's and that will let the market set the prices which people will be willing to join.
And nominally, I mean,
Yeah.
so when you join a co-op, you sort of agree to the pre-existing contracts at some level, but you also kind of have say to sort of rework things internally, and that's kind of an internal thing also, which the members might all vote to reduce it a lot.
Yeah.
If it's too high.
Or increase it if it's too
Or
low, or
increase it if
whatever.
it's too
Yeah.
low.
That's cool. That solves the problem.
And I think that democratically, people are actually quite reasonable, and if they work together, can come to reasonable solutions.
Cool.
But I don't think it's a fully worked out solution by any means. It's an idea of I think what needs to be addressed. I'm sure there's plenty of technical issues to be thought about.
Do you think the co-op model makes sense for today's economy, where we're moving away from labor and more towards kind of intellectual property and intellectual work?
Of course. But when you get into the intellectual property aspects, you get more into sort of patent law and owning knowledge issues. And in those cases, I would argue that really it's a problem with the sort of patent system and the ownership of that knowledge, and that you want to move more to a system where there's some reward for discovering things, and then that knowledge is actually public, because knowledge is a non-rivalrous good. And lots of people can use knowledge without harming the other person, whereas a car, only one person can use it at a time. So that's so it's a different type of knowledge, is a different type of good than the sort of traditional tangible goods. But I think worker co-ops would be totally fine for that, but I think that touches on some sort of different philosophical questions. No Goodwill questions?
I'm actually more concerned about creating more co-ops and having the ones that do succeed thrive and grow. I think that's one of the problems that occurs is in conventional businesses, a lot of them fail, a huge number of them fail. Actually, worker co-ops have a higher survival rate at the beginning, but what happens is every once in a while with this conventional business, they really take off and they expand because there's a lot of incentive for someone who's a concentrated owner of those things to grow, which there's not actually for worker co-ops in the current structure. Do you think, you may very well be addressing a different issue, but do you see ways where this would help cooperatives grow, if you consider that even a good thing?
I do.
Certainly it rewards the founders in a different way. What are other ways?
I don't see any good way to address the sort of general growth question, which I think is pertinent in the current environment, but I don't see any compelling ways to do that with the models I viewed. So, and this really addresses a different question of, is the startup process fair to the founding members as well as the later members? And my answer was sort of no, it's not. But this is more of an issue of sort of possibly slightly increasing the startup rate, and then also sort of making the structure a little bit more robust for existing co-ops. But it doesn't address that growth question, and I actually don't have any good ideas on how to do it. So.
I mean, what if there was a fund just like Fannie Mae was supposed to, was intended to create more home ownership? Couldn't there be a similar mechanism to help workers buy out? If we're not talking about startups necessarily, but simply buying out and their existing businesses.
And basically everything of scale is sort of done in that that field, which is the employee stock ownership plans. So for basically any large business, you could convert it to a partially worker-owned or even cooperative business. That's rare. By basically having a trust that buys up shares of the business, and then future profits go into that trust, and that trust is owned by the workers with or without control in various cases. The issue there is that what price are you paying for the business? And if it's a conventional business, you're paying the market price, which includes goodwill, which is basically saying the employees are then paying now for the future profits they're going to make, which is a sort of bogus game. And in practice, also for
even if they're paying now for future gains, couldn't that be adjusted once it's time for them to sell back their share to the co-op? Wouldn't they be selling their shares at the market value to the new members?
In practice, it takes place at market prices, and that's part of the problem. Is that it's sort of this market-based system where there's a sometimes substantial goodwill component, and that the only time you get a business at the net asset value is if it's either failing or in a dying industry, or there's some very generous owner, which is basically the case for most ESOPs, is that the owner takes a lower price than they could get on the market in exchange for tax breaks and whatnot. But I think conversion at the net asset value is sort of the right way to go in the long term when you want to sort of convert all businesses to worker co-ops. Is that you pay what the net assets are worth. That's what the co-op is using. I don't know how to do it.
Yeah, exactly an hour.
Perfect.
Thank you, Mike.
Thanks, Mike.
I don't even want to touch that.
Yeah. Hey, you guys, here's a